Welcome everyone to this month's edition of On Track. It's the 30th of August as I record this, and we'll be reporting on all the latest figures to the end of July and all the latest news right up to date. I'm recording this from beautiful Queenstown at the moment. I've just spent a week presenting and attending the GPS Wealth annual conference, which is always action-packed, full of experts in all different areas that we bring in front of all our advisors to continue all of our ongoing education. Been a great week, and I'm staying on with the family for another week. So enjoying beautiful, chilly but sunny Queenstown. Firstly, as usual, quick general advice warning. All that means is this is not designed for any one person, particularly those who we don't know. It's designed for clients of McGregor Wealth Management, in particularly those that use our care investment methodology and portfolios. What we're going to cover today, we're going to touch on the latest economic news, put it into context. We had a nice little flash crash in August, which was gone in a minute. We'll talk a bit about that. We'll talk about the returns, which have held up beautifully over that time. Update on the usual hot topics at the moment and what's happening in the property and share market. And just once again, the wisdom of Warren Buffett on that quote, which is the stock market is a device to transfer money from the impatient to the patient. And we saw in that little flash crash early this month that anyone that panicked and sold immediately transferred money to the longer term patient. So that was one of the main news items, but now forgotten. You can see the bottom left-hand chart here, that little gulf that was created, only 5%. So not really even at the correction stage. Might have been a bit more than that, might have got to 7 or 8. But we've since pretty much fully recovered. So yeah, now forgotten, and it's hard to remember what caused it. There's all sorts of stuff I'll touch in on, supposedly what caused it shortly. But yeah, just another typical mini panic that is soon forgotten. It was partly caused by talk of a recession in the US compared to the hope of a soft landing. Now, there's not much difference between the two. A soft landing just means the economy slowed down. It didn't quite go into negative growth before the cycle changes and interest rates drop. If the US does have a recession, it's likely to be very shallow, which means, yeah, it may only drop by a fraction. Jury's still out on that one. We will see. And it's interesting. It shouldn't really be a surprise because the whole idea of having highest interest rates is to induce a slowdown so that interest rates can come back down and inflation gets squeezed out of the system. So it always fascinates me when I see people surprised at the slowdown actually happening when it's exactly what the Federal Reserve and the Reserve Bank are trying to engineer. So exactly as predicted, or exactly as it should be, in my opinion. We've got 9 weeks to go to the crazy US presidential race. You'll see it, the chart in the middle there shows that it's about square with the bookies. It's interesting that people are now looking at the bookies to predict these things rather than the pollsters who've got it wrong consistently around the world. And it's a battle of two less than optimal outcomes. I think there was a great article I read during the month that said for most voters who would be in the middle, they're probably dissatisfied with both sides. They'll probably vote who they normally vote for, and some in the middle may decide at the end. But neither one is going to do horrible things to the economy, but neither one is probably going to do great things to the economy. But we will see. History always remains to be written. The advantage of that bad news now coming out around economic slowdown is that will bring a rate cut forward. The markets are predicting an almost certain rate cut in September in the US, and the markets in Australia, in spite of the Reserve Bank governor saying we're still watching the data, we still think it's going to be longer. The markets are now betting on December. Not that the markets are always right, but that's probably where we're going to start to see some rates. Interestingly, Westpac cut their fixed rates. The 2-year fixed rate this year, that's the first drop we've seen in a fixed rate. So that could be the start of a bit of a battle, and it could be the start of the banks preempting the Reserve Bank in anticipating. You may have noted they've dropped their term deposit rates slightly. When we look at the rates in the table on the right, RBA cash rate, still no change. 90-day bank bills are still in that similar zone as well. The 10-year government bond yield, I'll talk in a minute, but it dropped below 4%, but hovering pretty close to bang on 4% at the moment. Aussie dollar had a bit of a climb in the last few days to be up around 68 cents. CPI, the advantage of me being a little bit late this month, as I get to see the numbers. So 3.5%, the most recent number. So you can see it's coming down, still stubborn, but I feel like we're about 3 or 4 months behind the US on this, and I think we will see it drop in. The Reserve Bank has to talk tough on this because they don't want it to leak into general price rises, wage rises, etc., because then it can get stuck. But it looks like the war is won. And as inflation drops, as it has in China, Europe, and the US, we'll often import some of that inflation. That means, yeah, we kind of catch the same problem as whatever the rest of the world has. So eventually, slow inflation will come here too. And it's probably not that far away. We'll be talking about deflationary forces once again, as we were pre-COVID. And we'll forget what we were worried about as usual. Mortgage rates, no change. Although, as I said, one institution, Westpac, has dropped their fixed rate, but you'll see Macquarie here has dropped their term deposit rate, not by much, still healthy 4.7. But I think we're seeing the start of the market starting to drop what they're going to pay to people, but also potentially start to drop mortgage rates. So bad news for deposit holders, good news for mortgage holders, and that will play itself out. In terms of the care portfolio returns, in terms of the dial, our market view, the result of the flash crash. So this is always up to date. By the way, we had our investment committee here in Queenstown as part of the conference last Friday. We brought the dial back to 8 just to recognise two things: the fact the market did pull back, have a bit of a correction, but also the profit results are okay. So profits going up in the share market. So a little bit overvalued, but once again, we don't attempt to be super accurate on here because we know that we can't. And the two danger zones are the fear and the FOMO. In between, occasionally there's a bit of opportunity to trim or rebalance, but yeah, no real danger zone between sort of 4 and 10. Just our view on where the world is. When I look at returns, and particularly around, if I look at the 7-year returns compared to those targets, we've got conservative at 4.62, moderate 6.26 versus inflation +3. And keep in mind, even though we've had high inflation for the last year and a bit, for most of that 7 years, inflation's been low. So the portfolios are well ahead of target over the last 7 years, and they're certainly sitting well above average in terms of the peers. I'm at a different slide here. You've heard me talk about, and you've heard us talk about exciting life and boring money, not the other way around. And that's the underlying message from our investment process. We want your lives to be interesting and exciting, and your money less so. And so I thought I'd include in this segment things that we've dodged, because part of being successful long-term investing is making good decisions, but it's also about avoiding bad decisions. And I'm not saying Australian Super here has made a bad decision, but it's an area, the Fin Review from a couple of days ago, Australian Super, which actually runs about 341 billion, has had to write off 1 billion. So it's not significant. It's not going to make any Australian Super members broke. But what I find fascinating about this is all the industry super funds have got a lot of unlisted investments. So it's very hard to know how they're valuing them unless headlines come out like this. And we know that they've probably got a lot of these assets, property, infrastructure, and in this case, private credit, still valued at higher than they should be. So, yeah, for those still in industry super funds, if you're worried at all, and I suspect they will underperform for the next 2 years just because they haven't written their values down. And they've also got big and they've got less competition at the big end of town because the MLCs, the AMPs have all moved out of the market these days. So these guys now are the big gorillas, and I think there's a touch of hubris going on. So if you have people in some of these industry super funds that we would have once said were probably really safe choices, and that while they're still safe, I think they may underwhelm for the next few years, and then we may see more of this type of headline. So yeah, not a panic thing, but if you've got any money in these funds, we'll probably be having a chat about whether it's still the right place, particularly for the next few years. So updates on our wall of worry, and you can see that tiny little where I've got an arrow without a percentage. That's because it doesn't qualify as being more than the 10 or 12% needed for it to be a correction. But that's what the fuss was about for 2 days at least, when some people in the media, etc., were kind of predicting Armageddon just because the market went down. And I'll talk more about that in a minute. But yeah, a beautiful uptrend that you want to be on. And as I said, the danger is around the fear and the FOMO, which we saw in the GFC. But the big danger also is that we do silly things during what we would call the wall of worry, based on things that are short term in nature while the market climbs. I'm pleased to say we got almost no phone calls around that little flash crash, with even some people saying, is this a good opportunity? And we did take the opportunity to rebalance some portfolios where appropriate with that little drop. But yeah, no need to. Every now and then, someone will say, oh, should you do an update, Rob, in the middle of one of those panics? And I tend to figure that once a month is enough for us as long-term investors to get an update on the market. And the only time in the last 6 years we've varied from that is during COVID, when the market dropped really quickly, and we actually had twice a month versions of On Track for 2 months, just while we're keeping you up to date. So you should assume no news is good news, or at least no news is nothing to worry about. We'll always update at the end of the month, but yeah, if ever there was any really substantial stuff, we would go out in the interim and not wait for the end of the month. So you should read that as, if you don't hear from us during the month, that we're not worried that anything major. And keep in mind, we have so many ways to balance out the short-term volatilities, including the reserves for our retirees. So these are things that we never worry about. We're absolutely interested. We're absolutely look at the causes and see if there's opportunity or things to be concerned about, but not to worry about. 10-year bond yields. You can see the blue line is where they are at the moment. The green line is a month ago. So a big drop. So once again, that's 100% caused by the markets now thinking the battle of inflation is gone. But you can still see that drop in the yield curve from, on the left-hand side, the cash rate down to 2 years before it steepens up again. So that is the markets predicting that interest rates will drop over the next 2 years, and we'll see cash rates drop, down lower than they are. Now, note the US cash rate is about 5.3%, so it's 2% above the Australian cash rate. So they're going to drop by more than us because they had to. We didn't go up as much. So the Reserve Bank, we're not going to see rates go back to 1%. We'll probably see them settle somewhere in the twos. It will be interesting to see where it settles in the States. Same on that long-term chart. You can see, at 4% in Australia, we're kind of smack bang at the middle in terms of the last 25 years, and probably settling into a new normal. And look at that. I've only shown the 1 year chart on US ones, so it's showing that it's low compared to the last year, which is that signal that inflation is probably, the war against inflation is probably won, or at the last bits of tidying up. So once again, just the brief reminder of our wall of worry context, that the market goes through these phases. Most of the time it's in the wall of worry where it wobbles up the hill. We're always worried about something or other, and we saw a great example of that this month. But eventually we stop worrying, we have a boom. That boom is always followed by a bust. We are neither in boom nor bust territory at the moment, quite clearly in the wall of worry. And that's caused by this swing of psychology from fear to FOMO, and FOMO being just fear of missing out, which is fear to greed. So greed is just fear of missing out on an opportunity. So fear drives us all, because we're all worried about these major declines. But we've seen in all those declines, 9 of them since 1900, that they all recover. The sun comes up, we get on with life, and we make good returns from the share market. I thought I'd, with the media doing what they do, but it was fascinating watching the way they treated this flash crash. So I've highlighted this month in Mess It Up that the media, don't let it be your advisor, or don't let it be the cause of the way you think long term, because it's so short term in this crowded out media world where social media and new medias are with us every day. They've even started to talk about the legacy media in the States being the old school TV channels, etc. So it's fascinating. But the media, and here's a good example from The Guardian, who are relatively central in their political views, relatively. I don't think there's any true central media these days, mainstream media, but this was their headline in the middle of the flash crash. Shares in New York and London tumble on fears of a US recession. FTSE 100 on track for its lowest close since April, and Japan's Nikkei suffers biggest fall since the crash of 1987. So trying to be alarmist. And then as you read on, they say hit by this global stock market rout triggered by fears of recession. Then NASDAQ index, which had gone up, as we've talked about in the last few months, so much this year, but it pulled back by 6%. S&P pulled back by 4%, and they're absolutely big intraday moves. But in a world of quick information, we see a lot of these corrections happen really quickly these days. And it's no different, still no reason to panic. The Dow Jones, which is more broader than NASDAQ or the S&P, so more industrial, about a 2.8% decline. I won't go through all of those. Yeah, Japan, it was triggered in Japan partly by what they're doing with the exchange rate over there, and there was an interest rate rise over there, which triggered a 12% drop in the Japanese market and then infected around the world. But as I said, it came out pretty quickly over the next few weeks, so we're back to where we were. It's interesting watching economists at this time. All of a sudden, every media outlet is quoting economists, and they're all predicting things as if they have a great track record of predicting. And we know from many of my conversations that economists have no track record of predicting anything. They predict kind of the status quo, the direction, but no accurate predictions. But at these times, they're all out with their predictions. And that's partly because of this behavioral bias, the one we call overconfidence bias, that the more people know about something, the more overconfident they are. And I'll give you an example. It's not on this slide, but there's a stat, and this came out at one of our sessions at the conference, and it was a reminder of something that I've used many times before. But drivers, 60, I'm sorry, it's about 68%, nearly 70% of drivers think they're above average, which obviously only 50% of people can be above average. But the smarter you go up the curve, the more people think they're above average, to the point where fund managers and academics, so potentially some of the smartest people around, 90+% of them think they're above average compared to their peers. Now, you can obviously only have 50% of people above average because average is in the middle, but 90% of academics and fund managers plus think that they're above average. So these are the exact people who we then hear from in whatever crisis is going on. Not saying they're not smart, but they overestimate their ability to predict the short term. The four pillars of our strategy, of our core processes, and I've highlighted the one that matters the most in the long run, but we can forget about in the short run when these things happen, that is forget timing. It's time in. A little flash crash like we had, there's no way anyone could have predicted that that was going to happen, let alone make money off it by making, three good decisions. One is there's an issue. Two, to get out or to get in, and three, when to get back in. That sort of trading is almost impossible. And that's where the time in is so important. We do counter that with some protective measures when markets get a bit hot or a bit cold. So let's have a look around the different markets. Aussie shares were up 4.13%, but that is in July. And you can see here that the end of July was the peak just before that flash crash. And you can see that significant drop, but then the slow grind back to where just below that. So markets, as they close today, will probably have August as a flat month to slightly negative, depending on the markets, but not too bad because we've had a fantastic 7 months. So you would expect that. You can see that in the continuing compounding of growth. Aussie shares with dividends reinvested, 10,000 grown to 24,000 over the last 10 years. And you can see the beautiful diversification you get. And that's just looking at the top 10 stocks there. BHP still sitting on top, but BHP's had a pretty ordinary year, minus 2.75, but Commonwealth Bank has had a spectacular year. So you average those two out, there's a 20% return. You can also see most of the banks have had a good year. They do look a bit expensive from where they are at the moment, but they will even out in the rebalancing process, etc. And the worst one out of there, Woodside Energy, down 24, but the best, Westpac, up 51%. So once again, beautiful, boring diversification does its job quite nicely. US shares, also you can see the flash crash down a bit more. Partly that's because the Aussie dollar's been up as well, but absolutely spectacular over the last 10 years, where $10,000 has compounded to just under 47,000. And this is where we pick up the stocks that are driving the world at the moment in terms of technology: Microsoft, Apple, Nvidia, Amazon, Meta, which is Facebook, Alphabet, which is Google, and then Warren Buffett's Berkshire Hathaway slots in there at eighth place, and then a couple of others. But yeah, very comfortable. with that. We've got US shares as slightly expensive, but profits keep going up, so we have no great concerns there. Global leaders, once again, many of the same companies. Brings in a few outsiders, but it's that large cap tech, predominantly US companies that are driving, that are part of that top 100 companies in the world, or at least the top 10, or the top 100. So you can see once again that market it weakened a little bit on the global leaders, but then that drop and close to 10% on these ones, not quite 10%, but then back up a little bit weak at the moment, but nothing to fear. And once again, spectacular over the last 10 years, where $10,000 has grown to 42,000. So on to US small caps, and a fascinating month in July. US small caps went up strongly. They'd been having a pretty flat year, but all of a sudden the year's return was up to 17.5%. We'll see that pull back slightly because it did fall in August, but still we'll end we'll end August with a solid 12-month return. And over 10 years, 13.73%. And once again, you can see that means compounding has taken $10,000 through to 44,000. Less companies in there that you'll be familiar with. This is small caps in the States, pretty large caps compared to Australia, but they're not the ones that appear in the headlines. They're the backbone and the work center of the US, and always would be expected to outperform large caps in the long run, which is why they're such an important part of our portfolios. Also expected to outperform in the long run is emerging markets, which hasn't been the case in the last 3 to 5 to 10 years, but a very important part of the portfolio, a smaller part of the portfolio, but important nonetheless. At the top end, you can see the stocks on the bottom left-hand corner. At the top end of the emerging markets, you've got companies like Taiwan Semiconductor, Tencent, Samsung, which is based out of Korea, the phone company, of course, Alibaba, the Chinese Amazon, but trading at much lower PEs. PEs very low here, but some very big returns. You can see Taiwan Semiconductor, 73% 1 year return. And that's partly driven this index to be up 8% over the last year, which is a solid return, slowly starting to come back. And we expect this to be an area that in the next few years will probably re-rate. Part of the reason it's underperformed the last 3 years has just been a bit of a fear that China's in a slowdown and is sometimes a bit closed. So there's a bit of sovereign risk, but I feel like this is coming back. And even with that underperformance, $10,000 over the last 10 years has seen that double to 20,000. So we go to gold next, which is our canary in the coal mine. Gold goes up. It didn't go down during when everything else went down. It's just been solid, 26% for the year. It's down a fraction since then, but it's going to, by the end of August, it'll be 20, 25, 24. And just been a brilliant hedge for the volatility in the share market. We do expect the next 6 months with the US election and interest rates coming off, and there'll be a mixture of bad news and good news, just which is totally expected in many ways, because you do expect a slowdown at the end of this interest rate cycle, but it will be misinterpreted. We expect to see market volatility, but all that is just buying opportunities, rebalancing opportunities, and just part of the nature, which is the market. So let's jump over to property market and some updates there. We have a similar concept here, but it's more boom, bust, and boring. In that the share market, the property market goes through short periods of fairly rapid growth, bit of consolidation, not always a bust, but it just slows down, and then an uptick again. It's been a fascinating market the last few years, post-COVID, where many predicted pullbacks, but we've actually had a boom. When we look at the results over the last month and year, we can see that, and just looking down, Perth still on top with a 24.7% return over the last 12 months. Adelaide with 15, Brisbane with 15, Sydney and Melbourne relatively slow, although Melbourne especially. Sydney solid 6%, but Sydney was in front. The next chart shows the median values. One of our presenters at the conference had some great historical charts on property, and I'll include those in next month's On Track, just the history of all the different capital cities relative to each other. And like we said, we've seen Perth going from very much the bottom of the table, the caps, to up where you would expect it, similar to Brisbane and Adelaide. Melbourne's the one that looks pretty low there at the moment. It's been partly driven by a few things. One is As COVID drops in student numbers, as they talk about immigration cuts, still massively solid immigration, but also the land tax that came into Victoria. So people now paying, land tax on any property for the land component over 50,000. That will pass. That will just soon be considered a cost of investing in Victoria and Melbourne. And I suspect that gap, that's a fairly high gap between both Melbourne and, say, Brisbane, where Melbourne's median value is now below Brisbane. But it's also a gap to Sydney. Normally, Melbourne would sit somewhere between Sydney and Brisbane. So you would expect that'll probably close by Melbourne going up or the others staying steady while Melbourne goes up or the others pulling back. But having said that, there's still lots of experts predicting growths. I'm going to skip over the vacancy rates, but still incredibly low. Mortgage rates, almost no change. Well, these slides haven't changed one bit in terms of the data, but like I said, we're starting to see a little bit of action with Westpac dropping a fixed rate. We'll see whether that lasts. I think it will. I think we'll start to see more of that as the banks and their treasury departments start to anticipate rate drops. This was fascinating. An article I saw somewhere, source Oxford Economics, looking at the price forecasts. Always dangerous forecasting, but I'm always interested in what they're doing. So it shows the median price expected by June 2027. So you've just seen, and here they've got houses in Sydney, expect to go up to 1.93 million units at 1 million, Melbourne up to 1.28. So pretty much across the board there increases, less so on some of the smaller cities of Hobart and Darwin. Like I said, fraught with trouble, but here's why they thought property prices will still go up, even though in theory we've got high interest rates. But one of the reasons was wealthy buyers entering the market with high deposits. So there's still plenty of people making money. There's a lot of downsizers out there who've sold up their houses in expensive areas and they're buying debt free. 1/3 of properties purchased in the last year were transacted with no mortgage at all. So that's hot money that's going to keep prices solid. The Bank of Mum and Dad is helping kids with property deposits. It's common amongst many of us and our clients at the moment, where possible. It is going to create a class division of those who do have a Bank of Mum and Dad versus those that don't. And we're seeing inheritances compound that, where as parents are inheriting from their parents, they're passing on some of that to help their kids get into housing, which I think is kind of fair, given the luck of just where you're born and where you buy houses. Think about someone that bought a house 50 years ago in somewhere like Bondi in Sydney versus someone who bought a house in somewhere like Gladstone in Queensland. Pure luck in some ways, and the difference between what that property would have built is staggering. And that's helping. It's helping their kids and grandkids stay within that area by passing that money on. But it is a divide because not everyone is inheriting. So those that don't obviously have to work much harder to get into those areas. We'll see how these forecasts pan out. As you know, they often don't, but who knows? But always fascinating to look at. From our wonderful friends at Performance Property who help our clients acquire good quality investment properties. You can see where they have the market. So plenty with a bit of momentum, still some at value with Perth, Cairns, Rocky, Darwin, Townsville, Gladstone, Mildura, Mackay being in that value bit. Now note the color coding at the bottom. Performance Property classify these two colors as a trading asset. So one is where you buy it, take advantage of the next 6 to 9 years, and then maybe rotate out of that. But the blue chip, in their words, of property is where you're probably holding for a long time, 10 plus, including forever. The cheapest of those, probably Brisbane. And yeah, it's interesting seeing some areas like our own Sunshine Coast getting towards they're still at hold, but certainly not at the peak. And some areas falling a little bit, or with the risk of falling a little bit, particularly around Sydney and Melbourne, some of those related areas. Melbourne looks like it's getting towards the end of that stagnation, and I suspect will probably be in the value area, which means good opportunity somewhere in the next year. I would think, but once again, I'm no expert as well, but I do like to pull all this stuff together to help you guys find stuff that has high probabilities, but never any certainty of succeeding. That's a wrap. So let me just go through the summaries as always that, yeah, All investing best done as part of a real plan, which has some goals, which are your goals based on your life and what's important to you. Portfolio is designed to fit that goals, and then we do always take a long-term view. The boring old three: diversification, asset allocation, and liquidity. Liquidity just means we've got enough money set aside to never cop any impact from any downturns. We get 70 to 80% of our market exposure through low cost indexing, which gives us a gain in the long run by just having low cost. We protect against short-term volatility with that reserves, as I said, but for our wealth accumulators through dollar cost averaging and the boring stuff, regular rebalancing. And as always, there's only three ways to lose money in the share market. One is panic and sell, the others have to sell, and the other is not properly diversified. By our regular planning process and regular catch-ups with you, we avoid ever having to do that, which means we win in the long run, barring very unusual circumstances. Thank you as always for your attention. Look forward to chatting when next we meet. And until then, Rob McGregor signing out.